Section 1. A diamond in the rough. Unveiling a mispriced opportunity. The market is a sea of noise, you know. Most investors chase fleeting trends. They often overlook solid, cash-generating businesses right in front of them. Today, we examine such a company, Verizon Communications Inc., VZ. As of this morning, November 17, 2025, its shares trade for $41.80. Many have written off this telecommunications giant as a slow-growth utility. That view is a mistake. It ignores the durable nature of its business, its substantial cash flow, and a valuation disconnected from its strength. This is not for gamblers seeking quick gains. This is a potential cornerstone for the patient value investor, offering income and the prospect of capital appreciation as the market corrects its oversight. Understanding Verizon requires looking past the glamour of high-flying tech. It provides essential infrastructure. Its wireless and broadband networks are non-negotiable services. Predictable, recurring revenue in uncertain times. Extensive fiber and 5G are long-term assets. The market price fails to appreciate the moat they create. Section 2. The numbers don't lie. A look at price and earnings. At $41.80 per share, valuation starts to get compelling. For the last 12 months, earnings per share were $2.75. That implies a trailing price to earnings of roughly 15.2. Modest for an oligopolistic industry with high barriers to entry. This is our baseline. Now, we look forward. Consensus projects approximately $4.65 EPS in 2025, reflecting normalized costs and 5G benefits. If that holds, forward PE drops to a mere 9.0, a single-digit multiple for a blue-chip leader. Either the market is deeply skeptical, or it's overlooking earnings stability and modest growth. Beyond PE, price to book is about 1.7, reasonable for a capital-intensive business with tangible infrastructure and valuable intangibles. Valuation anchored to operational assets offers downside protection, a margin of safety. Trailing PE of 15.2 isn't demanding. Forward 9.0 is objectively low. The gap between today's price and future earnings potential is the heart of the opportunity, especially as the market fixates on subscriber growth and capex while underpricing the cash machine already in place. For many investors, income is a crucial part of total return. Here, Verizon shines. It pays a quarterly dividend of 66.5 cents, $2.66 annually. At $41.80, that's an attractive yield of about 6.4%. In a volatile rate environment, that steady cash return cushions drawdowns and pays you while you wait. On LTM EPS of $2.75, the payout is roughly 97%, seemingly high. But dividends are better judged against free cash flow. Guidance: over $18 billion for the full year. With roughly $11 billion in dividends, the FCF payout ratio is a healthier 61%. Cash generation covers the dividend and funds deleveraging and investment. Verizon has increased its dividend for 18 consecutive years, a deliberate, disciplined record. A growing dividend forces judicious capital allocation and signals management confidence. For the value investor awaiting recognition, a 6.4% yield is a powerful incentive. You are paid handsomely to wait. Valuation is supported by revenue, and by turning that revenue into profit. For full year 2024, total revenues were $134 billion, with net income of $11.6 billion. In 2023, revenues were $136.8 billion, and net income $21.3 billion. Declines driven by lower equipment sales and special items. Adjusted for one-time effects, underlying profitability looks more stable. Service revenue is the foundation. Monthly bills from over 100 million wireless subscribers create predictable cash flow. Recent filings show positive postpaid phone net adds, and fixed wireless access has opened a new growth lane. Despite competition, scale and network ownership sustain margins. EBITDA consistently in the mid-30% range. Capex is high, but cash from sales is substantial. Funding the dividend, paying down debt, and reinvesting in network superiority. The market underestimates the durability of these margins and the cash they produce. While seen as mature, clear catalysts can unlock shareholder value. Primary driver: monetizing 5G after tens of billions invested. Premium plans lifting ARPU and fixed wireless access expansion. FWA is now a multi-billion-dollar business that didn't exist for Verizon a few years ago. A multi-year cost-cutting program aims to remove billions in annual expenses, lifting EPS or funding growth without new debt. Consensus: low single-digit revenue growth, around 1 to 2%, with mix shift and savings driving faster EPS growth. Debt after 5G spectrum was a concern. Management prioritized paydown. Debt to equity sits around 1.8, with strong FCF reducing obligations and risk. As leverage falls, financial risk declines, and more cash can return to shareholders. This quiet deleveraging story is a powerful catalyst the market may not have fully priced in. No investment is without risk, and Verizon has its own. The US wireless market is intensely competitive. Aggressive pricing from T-Mobile and AT&T can pressure growth and margins. If price wars escalate, higher promo spend or lower prices could dent profitability. Execution matters, especially FWA scale-up and cost targets. Regulatory shifts and future tech transitions can reshape the field. Yet the case is compelling. Forward PE near 9 implies margin of safety, a well-covered 6.4% yield, a market leader with indispensable cash-rich services and modest growth drivers. For the patient value investor, Verizon warrants serious consideration. Begin accumulating around $41.80, steadily over time.